It's no secret that China is a major threat to U.S. hegemony of advanced tech, specifically the semiconductor industry. There have been moves by multiple presidential administrations now to reduce United States exposure to the Chinese market in regard to semiconductors. From outright bans on sales to China to import tariffs on Chinese manufactured goods, U.S. policy towards China is one of isolation and exclusion. And this is affecting some of the premier chip makers in Silicon Valley. Welcome to The Quality Investor. Applied Materials actually posted decent, not great, but decent year-over-year revenue growth for their fiscal year Q1 of 2025. They posted nearly 7% year-over-year growth despite significant headwinds in their primary market, China. China accounted for 27% of AMAT's total sales in fiscal year of 2023 and a whopping 37% of total sales in fiscal year of 2024. Applied Materials supplies major Chinese chip firms such as SMIC, YMTC, and BOE Technology. SMIC is China's largest foundry, and BOE is China's largest display manufacturer. They sell semiconductor manufacturing equipment, tools, software, and OLED and LCD display equipment. In other words, China touches all parts of Applied Materials business. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. It is no wonder then why the market seems to have Applied Materials out of favor at the moment. The US has banned highly sensitive technology from being sold to China, and this is estimated to cost Applied Materials around $400 million in sales in fiscal year of 2025. Not only that, but Applied Materials is still under investigation by the DOJ for sales and restricted exports to China. The new Trump administration has now reinstated and expanded tariffs on steel and aluminum imports, now 25%, which are major raw materials for Applied Materials. So short term, there seem to be many challenges ongoing for Applied Materials. The tariffs in particular have the potential to contract margins, ultimately reducing cash flow for the business. But here on The Quality Investor, we focus on the long term for investing. And while the short-term prospects for AMAT appear grim, long-term, they are well positioned to capitalize on the nascent AI revolution and data center expansion. AI models require highly optimized and specialized chips, and these require cutting-edge fabrication equipment to manufacture, all of which Applied Materials provides. AI and data centers require high-speed memory solutions. Applied Materials provides the technology to enable the faster and more efficient memory production. AI-driven data centers also require enormous power consumption. Applied Materials is developing power-efficient manufacturing techniques and new materials that reduce power consumption in AI and cloud computing chips. This is the long-term value that Applied Materials will create. They are a necessary component of the semiconductor supply chain. NVIDIA, Amazon, Google, and Microsoft are primary drivers of demand for the world's most advanced and sophisticated chip technology. This, in turn, drives demand for the equipment to manufacture these chips, which is where Applied Materials stands to benefit. So let's look at Applied Materials' latest earnings, assess how they are shifting away from China, and what their potential growth indicates for their intrinsic value. I present the fiscal year 2025 Q1 results. We can see in that first quarter here, they had revenue of $7.16 billion, which was a 7% year-over-year increase. The other notable things here is they continue to expand margins despite the trouble that we're seeing in China. Gross margin on a non-GAAP basis, at least, at 48.9%. Operating margin on a non-GAAP basis at 30.6%. You can see the basis point expansion year-over-year at 100 bips for gross margin and 110 bips for operating margin. Now, even on a GAAP basis, their margins did expand. So Applied Materials can potentially absorb some of those tariffs to the raw materials that they'll be using as they balance out their supply chain to readjust their suppliers. And finally, we have earnings per share at $2.38. Of course, this is non-GAAP, but it was up 12%. So despite the troubles that we're seeing with their largest geographical segment, China, Applied Materials is posting solid growth. It appears we're coming out of the semiconductor cycle low that the entire industry has been in over the last 18 months or so. And a lot of that is driven by the demand now we're seeing for AI and data centers. And here's why that is very important. We're looking at the breakdown of revenue by geography for Applied Materials. The United States, $917 million in revenue, 13% of their total revenue. The United States is not a strong manufacturer of semiconductors. And of course, as a supplier of equipment to manufacture semiconductors, it stands to reason the US is not going to be a strong buyer. The base of manufacturing is actually in Taiwan. And we see something interesting here. 1.183 billion in sales to Taiwan. Taiwan Semiconductor being the largest customer in Taiwan and the largest producer of chips in the entire world. 17% of Applied Materials revenue came from Taiwan. Now, that doesn't seem like a lot, but that is up from 8% in fiscal year 2024 Q1 in last year. Now let's look at China. China, of course, has a large foundry, and SMIC still did 2.2 billion in revenue to China, 31% of Applied Materials total revenue. That is actually down from 45% of revenue in the same quarter last year, when they did 2.99 billion. So not only did Applied Materials grow their revenue 7% year over year, you can see they shifted their customer base primarily to the two other large manufacturers in Asia of chips. And that is Korea at 23%, up from 18% last year, and like I mentioned, Taiwan. So while the China market is certainly presenting issues for Applied Materials, they're already adjusting their business. And I expect to see the United States sales become a larger percentage of total revenue as well in the coming years. Taiwan Semiconductor has already signaled that they want to begin manufacturing chips here in the United States to avoid the tariffs. And the Trump administration as a whole has signaled its desire to bring a bulk of semiconductor manufacturing back to the US. This is only going to benefit Applied Materials in the long run. Applied Materials closed the week on Friday at $169.20. And of course, we see that large drop they incurred on Friday the 14th after earnings, down a not so hot 8.2%. And I believe the reason why is something I briefly touched on already. The trade war we're seeing with the tariffs, as well as the pullback in China sales. China is their biggest customer. They will need to make that up somewhere, and that's what the market's fearing right now, despite the fact that Applied Materials beat both on revenue and earnings per share. And when it comes to Applied Materials, it seems like the market is completely fixated on China. But to me, that really misses the much bigger picture with Applied Materials, and that is what it's doing for AI and data centers. Now, Applied Materials is not a direct AI play. They're not building any LLMs or anything of that nature. What they are doing is building the equipment that builds the LLMs of the future. This is from a write-up in Yahoo Finance a few weeks ago. They are claiming upside potential for Applied Materials at 29%. Remember that number, 29%. It states, the company is a direct beneficiary of advancements in AI and the increasing semiconductor content in connected devices. Applied Materials is positioning itself to be at the forefront of technological inflections. Applied Materials technologies enable the production of advanced chips, such as memory and logic processors, essential for powering data centers and supporting applications like machine learning, cloud storage, and big data analytics. I mentioned Amazon, Google, and Microsoft at the outset of this video. In this article, tech megacaps plan to spend more than $300 billion in 2025 as AI race intensifies. Amazon, Alphabet, Microsoft, and Meta intend to invest as much as $320 billion this year into artificial intelligence technologies. Technology companies are racing to build out data centers and AI infrastructure that will put them ahead of the competition. And that's the important key here. Now, Applied Materials is not going to be a direct beneficiary of these CapEx dollars because they're not a primary customer of these businesses, but these businesses will need to spend big dollars to manufacture these AI chips, to install the memory needed for these data centers, all this compute power that they need. Applied Materials is manufacturing all that equipment that makes this possible. Applied Materials is a very indirect beneficiary of this massive CapEx spend, the largest CapEx spend we've ever seen from these magnificent 7 businesses. But what does all this mean for Applied Materials stock? Are they actually good value today with that pretty hefty drop that we saw of over 8% after earnings? I want to start right here in the middle in our revenue segment here. Their largest segment, Semiconductor Systems, has seen a 5-year CAGR of 17.14%. I'm only projecting them to grow at about 7.4%, and in the bull case, 8.5% over the next 10 years. Applied Global Services is growing a little bit faster at 7.3% on the base case and 10% on the bull case. Applied Materials itself is expecting low double-digit growth long-term for Applied Global Services. So I'm basically using 10% as my high end there for the bull case. But overall total revenue growth of 7% on the base case and 8.5% on the bull case. All in all, this is very modest growth for the company. Despite what we're seeing with these massive spends out there in AI and data centers, Applied Materials will benefit, but it's going to be in a very indirect way. I am estimating their operating margin to be 30% this year, 32% operating margin on the base case, and a 33% margin on the bull case. They are expected to pay a little bit higher in income tax this year, but overall, their income taxes shouldn't be much higher than 14.5% of the base case here. And finally, free cash flow conversion. I am expecting about 88 cents this year in free cash flow conversion, down from 94 cents than the previous year. This first quarter, they seemed to really beef up their working capital needs, which took a massive hit to their free cash flow. But by year 10, I'm expecting 93 cents for free cash flow conversion on the base case and 95 cents on the bull case. One positive aspect about Applied Materials is they paid an excellent dividend. And you can see this incredible dividend growth they've had over the last 10 years. 13.67% annually over the last 10 years, 12% over the last 5 years. And just last year, they increased their dividend by 24%. So going forward, I'm expecting 14.5% annual dividend growth on the base case and 16% on the bull case. They also have a very low free cash flow payout ratio. Ultimately, we can see what our final numbers are down here. So the free cash flow, what we're discounting back to today's price to find the intrinsic value of the business. On the base case, I have the free cash flow margin coming in at 24.68% by year 10, and on the bull case at 26.66%. Compare that to just last year where they had a free cash flow margin of 21.5%. So very reasonable free cash flow margin expansion over the next 10 years. So they closed on Friday at $169.20 with a PE ratio of 22.1, above their 5 and 10 year average here, and a forward PE 21.7, also above their 5 and 10 year average. On a bear case, I have a DCF price of $193.56, $229.36 for the base case, and $276.02 on the bull case. So just looking at the DCF prices for Applied Materials, you can still see there's a lot of upside. And this is with very modest free cash flow growth, about 5.8% annual growth in free cash flow on the base case, and 8.16% annual free cash flow growth over the next 10 years, mind you, on the bull case. Very strong dividend company, $242.58 on the dividend discount model for the base, and $296.62 on the dividend discount model for the bull case. The exit multiple is at $242.51. That is based on comps of KLAC, Lam Research, and Teradyne. And you can see that provides still, even on the bear case, massive upside from the valuation averages here. $208.01 for the bear case gives us a 22.9% upside. $235.95 for the base case gives us about a 39% upside. Right before earnings, this would have been about a 29% upside. The large dip is really providing some value here for Applied Materials, and 61.2% upside on the bull case. There's a lot of value to be had here, and I'm being very conservative in the estimates I'm giving for the capture of all of this investment coming for AI and data centers. In my view, the market's really scared about what's going on in China, but Applied Materials has been proving itself to shift quickly in its business to adjust to this new climate. So with no margin of safety, that's a buy price of $238.18. With a 20% margin of safety, we're going at a buy price of $190.54, a forward PE of 24.5. We're almost down into the 30% margin of safety territory right now, sitting at just above the $166.72 price there. I believe this is a good stock to add to up until about $185, $190. There's a lot of room for growth here. They produce a lot of cash, and they also have a very healthy return on invested capital. 28% ROIC, right smack dab in the middle of their already very good ROIC numbers. This is a business that knows how to invest smartly for its future, and the ROIC is a demonstration of that. So Applied Materials, I think, has a lot of room to run still and is poised for big things as we continue on the march to expand for AI and data centers. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.